All right, let's just jump right into this. Welcome to this explainer, where today we are completely decoding the hidden macroeconomic forces that are literally driving your portfolio's biggest moves. If you're a retail investor trying to make sense of all these wild market swings we've been seeing, well, you've definitely come to the right place.
So, have you ever actually wondered why completely different assets, like, say, a crypto coin and a basket of big tech stocks, why they often just suddenly surge or plummet in absolute perfect sync? I mean, it kind of feels like they're tethered together by some invisible string, right? You build this nicely diversified portfolio, and then, boom, suddenly everything is flashing red at the exact same time. Like, why does that actually happen?
Well, the answer lies in something called global liquidity. Think of this as the invisible plumbing of the whole global economy. Or actually, a better way to look at it is like the rising and falling tide of the financial ocean. Global liquidity is, simply put, the total amount of capital flowing through the system at any given point. When the tide comes in, it lifts all the boats. But when it goes out, yeah, that's when things get pretty dangerous. So here's our game plan for today. We're going to systematically map out exactly how this tide works. We'll cover the invisible market tide, the main faucets of global liquidity, how different assets ride that wave, the hidden risk undertow you need to watch out for, and finally, how you can navigate your own portfolio risk.
Okay, part 1, the invisible market tide. Let's get a handle on this hidden flow first.
Because liquidity absolutely isn't static, it's not some random walk. As we can see here, liquidity actually ebbs and flows in these massive cyclical waves. Researchers at Cross Border Capital have identified this roughly 65-month wave, so about 5.5 years, that systematically lifts and lowers global markets. The black line is the Global Liquidity Index, and that red dashed line, that's the underlying cycle. Realizing that you are swimming in an ocean with these predictable long-term tidal shifts, that's step 1 to becoming a much more resilient investor.
Moving to Section 2, Faucets of Global Liquidity. So, where does all this financial water actually come from in the first place?
Basically, the Global Liquidity Index is controlled by 4 massive faucets. First up, central bank balance sheets. When institutions like the Fed or the ECB expand their assets, they are literally pumping more liquidity into the markets. Second is the U.S. Treasury General Account, basically the government's massive checking account. When that balance is low, that cash is out in the wild, which means more liquidity. Third, we have the reverse repo facility. Think of this as a giant overnight savings account for banks. If less cash is parked in there, liquidity out in the broader market is looser. And finally, the M2 money supply. This is the total cash and deposits circulating out there. Higher M2 generally means stronger markets.
And that brings us to a massive shift happening right now. For the past couple of years, central banks have been cranking those taps completely shut through something called quantitative tightening, or QT. It's been a brutal headwind for markets. But as that contraction process finally bottoms out and central banks pivot, this macro headwind is neutralizing. The tide is actually preparing to shift again, flipping from a headwind to a potential tailwind.
All right, Section 3, how assets ride the wave. We know where the water comes from, but how do the actual assets in your portfolio react when this tide rolls in?
Well, some assets are basically speedboats. Take Bitcoin. Because it's a global asset with a hard cap of 21 million coins, it tends to just eagerly soak up extra liquidity the second those taps open. It loosely but very noticeably rides these global waves. When that black line liquidity spikes, Bitcoin is usually right there surfing the wake.
Tech stocks, like the ones heavily weighted in the NASDAQ 100, they act pretty similarly. They absolutely thrive during an expanding tide because all that extra capital funnels into cheap borrowing and investor risk appetite just surges. But when the tide goes out, when liquidity contracts, they struggle, big time. Borrowing gets expensive, risk appetite evaporates, and those sky-high tech valuations suddenly look incredibly hard to justify.
So just to quickly recap how your portfolio pieces fit together here. Bitcoin loosely tracks the liquidity wave. The NASDAQ is super responsive to the cheap borrowing tied to it. But what about the safe haven stuff? Well, gold is more like a heavy galleon. It rises long-term with liquidity, sure, but it really charts its own course based on global stress, geopolitics, and real yields. And those long-dated U.S. Treasuries? They're stubbornly anchored right to U.S. interest rate expectations. They rarely just blindly follow global liquidity.
Section 4, the hidden risk undertow. Because look, a rising tide is great, but it often hides some seriously dangerous undertows.
Here's the catch. Not all liquidity is created equal. There's some fascinating research from NYU Stern on shadow backing that points out a pretty terrifying trade-off. Basically, financial intermediaries create a ton of what they call fragile liquidity. It's credit and leverage that works flawlessly during the good times, but it's built on assets that can, well, crash. As the researchers put it, you can have a lot of liquidity most of the time or a little liquidity all of the time. And guess what? Our financial system definitely chose the first option.
This sets up a brutally predictable boom and bust cycle. Step 1, the central taps open, uncertainty drops, and everything feels amazing. Step 2, investors get greedy for returns and start taking on those shadow money risks, leveraging themselves up. Step 3, boom, a sudden macro shock or panic hits out of nowhere. And step 4, all that fragile liquidity just vanishes. It evaporates instantly. Everyone sprints for the exit all at once, triggering massive fire sales that can absolutely decimate a retail portfolio.
To put this fragility into perspective, just wrap your head around this number: $10.1 billion. That's the staggering amount recently stacked up in net short Japanese yen positions by speculative traders. What on earth were they doing with $10 billion? They were playing an incredibly risky, highly leveraged game called the carry trade. Basically, you borrow a currency with dirt cheap interest rates, like the yen, and you use that virtually free money to buy riskier, higher-yielding stuff all around the world, like U.S. tech stocks. They were completely banking on the assumption that the global liquidity tide would simply never go out, and that Japanese rates would stay near zero forever. And this is the perfect real-world example of that fragile boom and bust we were just talking about. On one hand, you had this massive, elusive boom. Japan's Nikkei 225 surged 30% this year, totally hyped up by AI stocks and that weak yen. But then came the fragile bust. The Bank of Japan just signaled they were going to hike rates, the cost of borrowing that yen spiked, and the tide violently reversed. Traders were forced into a chaotic unwinding. They literally had to dump their global assets just to pay back their yen loans. It sparked a massive sell-off that threatened markets worldwide.
Which brings us to Section 5, Navigating Your Portfolio Risk. As a beginner retail investor, how do you actually survive these sudden undertows?
First off, you've got to reframe how you look at the data. The Global Liquidity Index, treat it purely as a macro weather gauge. It tells you the long-term climate. Are we in a bull market summer or a bear market winter? Please do not try to use it as a crystal ball for day trading. It won't tell you what the market is going to do tomorrow, but it will absolutely show you the direction of the underlying current.
Your real investor's compass is all about discipline and diversification. Use the index to check the weather, but remember that different assets ride these waves in completely different ways. Tech and crypto might be your speedboats jumping the waves, but gold is your steady galleon. Because of this, spreading your bets across these different asset classes is literally the absolute best way to protect yourself against a sudden drain in the system's plumbing. And seriously, always be super skeptical of any market rally that looks like it's built entirely on debt, leverage, and fragile shadow liquidity.
Look, the plumbing of the global financial system might be practically invisible to the naked eye, but the undertow it creates, it is incredibly real, and it can pull you under if you're not paying attention. But now you know how to spot those changing tides. So I'm going to leave you with one vital question to chew on today. Is your portfolio actually ready for the next time the tide goes out?